All right, welcome everyone.
Hello, bonjour.
Okay, quick sound check. Can you guys hear us well? Very good. Salim as well?
Can you hear me? All right, so for context, there is a cable that has been cut, I think, in Dubai. So internet is extremely bad for everybody. If it's starting to glitch, please say it in the chat, and Doc and Rami will
take over.
take over. Yeah.
We try to do our absolute very best to make sure that you have the best conditions, but it's overall in Dubai. There's a big internet connection issue. We thought that we had the best country. But for once, you Americans can brag. You have a better Wi-Fi connection than we do. Yeah. But that's about it. Other than that, our taxes is way better.
Yeah.
That's for sure.
And it's all that matters.
All right. Maybe switch to Starlink.
It's a good question. I had Starlink. I had it, but apparently it was really bad.
Well, good suggestion. Thank you very much. All right.
Let's go. So, today marks a turning point in how we'll deliver these market updates. Why? Because we've been listening to your feedback on Circle, reading every comment, every question, and you've made it clear. You want less theory and more action, less macro dissertation, and more tactical moves that you can make today.
So starting today, we're splitting our market intelligence summits into two distinct formats. The one that you saw 2 weeks ago, the macro market update that handles the big picture analysis, global liquidity, major cycles, the forces that move all markets together. But today is what we call the micro picture, the actionable insights. This is pure tactics. What's rotating right now? Which positions can you possibly take? How to size them? How to exit? All the good stuff.
So we'll still give you context. You need to understand why all these moves make sense, right? So we'll give you context, but we'll be spending most of our time on actionable insights. Real trades, real allocations, and real strategies, right? That you can implement at this exact moment when the call ends. That's what we want. So
if you're excited, let us know. Let's go.
Let's dive in.
So, some housekeeping first. As you very well know, we want to make it clear the statements, insights, and perspectives we're about to share are educational observations and informational only. Neither I, nor Salim, nor Doc, nor Rami, nor anyone at Decentralized Masters are financial advisors. Nothing said here should be considered financial advice.
All right.
Let's start with macro and liquidity overview. And ding, ding, ding. Rate cuts are here.
Yay!
Next Tuesday, September 17th, the Fed meets. The market is pricing in 100% chance of a rate cut. Not 95%, not 99%, 100% certainty. When markets are this sure about something, you need to pay attention. But this isn't your typical rate cutting cycle, and understanding why changes everything about how you position. So let's start with a history that has everyone spooked. Major rate cutting cycles have historically coincided with major market crashes. Okay? The dot-com bubble burst in 2001. The Fed cut rates from 6.5% to 1%. The 2008 financial crisis hit. They slashed from 5.25% to 0. COVID struck in 2020, straight to 0 again. Look at that pattern, and I mean, you would be right? For panicking, you would be right. Every major cutting cycle in recent memory came with a market disaster. So a lot of people see rate cuts coming and think, oh, here comes the crash. But they are confusing correlation with causation. We already spoke about that for the past 2-3 months, but for those who are new, it's important to let you as well. The Fed didn't cut rates and cause those crashes. The crashes were already happening. Companies were failing, unemployment was spiking, credit markets were frozen, and so the Fed had to cut rates as an emergency response, trying to prevent complete economic collapse. They were playing defense, not offense. This time is completely different, totally different. So let us explain why.
So why the Fed is actually cutting? The Fed is cutting because traditional economic indicators are softening, but we're nowhere near crisis levels. Unemployment has crept up from 3.4% to 4.3% over the past year. That is still historically low. But what concerns them is the trend. The SAM rule, which triggers when unemployment rises 0.5% from its low, has been breached. And that's historically predicted recessions. Also, manufacturing PMI has been below 50 for 6 straight months, which indicates contraction. Consumer confidence is declining, credit card delinquencies are rising, commercial real estate is struggling with work from home permanence. The Fed sees this softening and they're responding with their traditional tool: lower interest rates. This is textbook central banking. When growth slows, you cut rates to stimulate borrowing and investment. They're trying to engineer a soft landing, cutting rates before things get bad rather than after. But here is the critical difference from past cycle. We are cutting from a position of relative strength. Corporate earnings are still positive. Banks are well capitalized with none of the leverage issues from 2008. Household balance sheets are actually strong. Americans paid down debt during COVID and haven't levered back up. So the system is stable. This is what we can call a preventative cut, not an emergency response. The Fed is trying to get ahead of weakness rather than react to crisis. That is a completely different setup than 2001, 2008, or even 2020.
If you paid attention in some of our last market updates, we told you this one is way more similar to the 2019 rate cut. The economy is looking very similar, and that was extremely bullish for the markets. Now, not only that, here is where things get interesting and why this rate cut will have consequences nobody is fully pricing in. Rate cuts work by making capital cheaper. So lower rates mean companies can borrow more cheaply, making marginal projects suddenly profitable. Traditionally, this leads to broad-based investment, new factories, new stores, more hiring across the economy. But this time, there is already a massive investment cycle waiting to absorb all the cheaper capital. And it's concentrated in one area: artificial intelligence infrastructure. Maybe you saw that clip with Trump. He was having dinner with Zuckerberg and Tim Cook, all the big guys, right? So Meta announced they're spending 40 billion on AI infrastructure this year alone. Not planning to spend, but actively spending, right? Purchase orders are signed. Google is committing 50. Microsoft, Amazon, Apple, combined, we're looking at over 300 billion in AI capital expenditure over the next 24 months.
So what you have to understand is that these companies were going to spend this money regardless of where rates were. So the AI arms race is existential for them. If they don't compete, they die. But now, with rate cuts, they can finance this spending with cheaper debt. So think about the math. A 1% rate cut on $300 billion in investment is $3 billion in annual savings. So that's $3 billion more these companies can plow into compute, talent, and infrastructure. The rate cut isn't causing the AI investment, but it's pouring rocket fuel on a fire that was already burning. This concentration effect is critical for your positioning. Previous rate cuts lifted all boats because the investment was distributed across the economy. This time, the investment is flowing into a very specific area. Every basis point lower is more money flowing into data centers, chip orders, power generation, cooling systems, etc. So these companies building AI infrastructure, right? The NVIDIAs, Broadcoms, Constellation Energies, they're about to see a demand surge that makes the last 2 years look quaint. Meanwhile, traditional rate-sensitive sectors, like housing, for example, might not respond at all because the money is not flowing there.
But there's something that is truly unprecedented, and why the Fed might be making a historical, is it even a miscalculation? Because they don't really have any say in this. In every previous cycle, rate cuts reduced unemployment through a simple mechanism. Cheaper capital led to business investment, which meant you hire more workers, which meant more consumption because they're getting paid a salary, creating a virtuous cycle. So the Fed could reliably count on this transmission mechanism, right? Well, this time that mechanism is broken because when companies invest this cheaper capital, they might not hire humans. They might just buy NVIDIA chips or build AI models. They're automating everything they can. Every dollar invested in AI infrastructure is essentially a dollar invested in replacing human workers. So the Fed knows this intellectually, but they're still operating from the old playbook because they don't have a new one, right? They're cutting rates to prevent unemployment from rising further, but the cuts will accelerate the very technological transformation that is causing job displacement. So we're about to see something that has never happened before. Massive corporate investment that doesn't create jobs. In fact, it might eliminate them. Unemployment could continue rising despite rate cuts and massive capital expenditure. So for the economists, right, the traditional Phillips curve relationship between unemployment and inflation, that is completely broken.
So when this becomes obvious, right, meaning when unemployment keeps rising despite rate cuts, the government will be forced to intervene with fiscal policy on a scale we haven't seen since COVID. Universal basic income, for example, massive retraining programs, direct government employment, and these aren't radical ideas anymore. They're inevitable responses to technological displacement, as we can call it. So for investors, this creates a clear roadmap. The rate cuts will create winners and losers, unlike any cycle before. Winners, companies building AI infrastructure, high margin software companies, automation providers. And what about losers? Labor intensive businesses, companies without pricing power, traditional rate sensitive sectors that won't see the capital flows. The Fed is cutting rates to prevent a recession again, but they're inadvertently funding the largest economic transformation in history. They're not fighting the last war. They're accidentally financing the next revolution.
All right, liquidity flows. Let's follow the money then. Here is what actually drives asset prices, as you know that, right? Global liquidity. But let's just say that what's about to happen should terrify anyone holding cash at this stage. Global M2 money supply that we've been following is exploding. We're talking about 5 to 7 trillion being added between Q4 25 and Q1 26. That's a 5 to 10% increase in 6 months on a base of around 110 trillion. So to put this in perspective, normal annual M2 growth is about 3%. We're about to do triple that in half the time. Typically, when there's a lot of liquidity that trickles into the economy, as you know, assets and risk assets tend to explode. Why is that? Is because every major central bank is cutting or about to cut. Fed next week, ECB already moving, China stimulating. When everyone prints together, when it's printing party, liquidity explodes.
Liquidity explodes. What does that mean? That means that your money is melting. Because when global liquidity expands 10% in 6 months, fiat currencies get debased. We call it like this. And the dollar already dropped 5% just on the expectation of cuts. Once the Fed actually cuts while others hold, expect DXY to fall from 100 to 93, 95, right? DXY, which is the relative strength of the dollar against other currencies. So that's another 5 to 7% devaluation that we expect. Now, here is the brutal math. If you're holding $100,000 in cash earning 5%, you think you're making $5,000. But if assets inflate 20% from liquidity expansion, you've actually lost $15,000 in purchasing power. Your money is literally melting while you sleep.
So this new liquidity isn't going into the real economy. Consumer spending is flat, housing is frozen, okay? It's going into financial assets, stocks, crypto, gold, anything that cannot be printed. And that is why you're seeing a little bit of everything rising simultaneously, right? The wealth transfer happening is massive. It goes from savers to asset owners, from cash that is literally losing value to anything scarce. So during COVID's liquidity expansion, stocks doubled, crypto literally went 10x, real estate jumped 40%, while cash lost 20% of its purchasing power. We're about to see it again, but concentrated in financial assets. So if you are not holding assets right now, you are not preserving wealth, you're losing it. There is no middle ground when $10 trillion in new money chases the same pool of assets. So the message is simple. In a world expanding money supply 10% in 6 months, you either own assets or get left behind. Cash is trash, and it's about to get trashier.
Listen to that, my friends. Now, let's talk about what might be the most important chart nobody's watching right now. Gold. Because when gold does what he's doing right now, it is trying to tell you something. Gold just hit $3,670 per ounce. So a new all-time high. It's up 37% year to date after gaining 27% last year. gold has outperformed stocks, bonds, real estate, basically almost everything except Nvidia and crypto. We called tokenized gold being one of our big investments multiple times over the past couple of months. Are there members here in the attendance who are currently profiting from these gold all-time highs? Say it in the chat, please. We will be extremely happy.
Yeah, who did follow what we said and is smiling right now? Great.
Absolutely amazing.
So, do you now see how taking our first profits from so many yes? Wow, amazing. Do you now see how taking our first profits from the exit ladder strategy and putting that into tokenized gold has been a beautiful strategy? Do you now see why? Okay, so most other investment gurus didn't necessarily see this coming like we did. And I mean, it's kind of understandable, okay? No offense. Here's what's strange. None of the traditional gold drivers are present. Inflation is coming down from 9% to 3%. The dollar index is still okay at 97. Real interest rates are positive, and we're not in a war beyond maybe Ukraine. So why is gold exploding? Because typically that's not how it moves. Central banks are buying at a pace we've never seen before. China added 316 tons this year. Russia, India, Poland, Singapore, they're all loading up. They're not announcing it. They're not making it public. They're just accumulating. And they are not buying because of inflation fears. They're positioning for currency debasement. They see what's coming. Governments will print whatever it takes to manage also this AI transition and the social disruption from unemployment. The infrastructure investments needed for the shift and the potential for social unrest. So they're gearing up because all of this requires massive fiscal spending.
So when China looks at their $800 billion in US treasuries, they see risk. Because imagine this. If the dollar drops 20%, they lose $160 billion. If the US sanctions them like Russia, they lose everything. And gold can be frozen. It can be printed. It can be sanctioned. And is the ultimate trust no one asset in a sense, right? And the fact that nations are choosing it over dollars tells you everything about what's happening.
By the way, quick live question answering from John Dupont, who says, are central banks also buying crypto at all? If not, why not? Well, countries are, right? You know that governments are buying Bitcoin, but if a central bank starts buying crypto, it might as well just say, you know what, we're done. We're going to close shop.
Yeah.
So they can't really do that just now. But nations are. That's what you should know. All right, next section is, well, gold at 3,600 as of speaking right now, while stocks sit at records, creates a paradox that most investors are not used to seeing. Okay, traditionally, gold rises when stocks fall. It's the fear trade, it's the hedge, it's the insurance policy. But both hitting records at the same time, that is not normal. Here's what it means. Smart money is not choosing between stocks and gold. They're buying both because they're buying both and crypto, okay? Because they see the same thing. Massive currency debasement ahead. Just get out of fiat, right? So stocks rise nominally as dollars become worth less. Gold rises as a store of value against that debasement as well. They're not competing stories anymore. They're the same story told in different languages.
So that explains the schizophrenic behavior that we're seeing in equity markets. Record highs that nobody trusts, rallies on low volume, and institutions hedging at levels that suggest fear and not greed. So they're riding the liquidity wave while buying insurance against the inevitable crash. So let's look at what this means for specific stocks and sectors.
And yes, this is the big surprise of this new format. We're also going to talk about equities. Yay! So let's do it. Okay. The S&P 500 closed at 6,500 last Friday, another record. The Nasdaq hit 21,900, another record. So you would think that everyone is celebrating, right? Well, instead, institutional investors are terrified. And here's why. Only 40% of stocks in the S&P 500 are above their 50-day moving average. Think about that. The index is at all-time highs, but most stocks are actually declining. How is this possible? 7 stocks, Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, they now represent 35% of the S&P 500's total market cap. So out of 500 companies, just 7 control over a third of the entire index value.
And you know what? These 7 stocks are up an average of 68% this year. The other 493 stocks, they're up 4% on average. Many are actually negative. So this isn't a market rally, right? It's 7 stocks dragging 493 corpses to new highs. But here's where it connects to gold's warning. These 7 giants aren't rising because of spectacular earning growth. Revenues are up maybe 10 to 15% on average. So why are they rising? They're rising because of multiple expansion. Investors are paying more for each dollar of earnings. Why? Because in a world of currency debasement, you want to own the best assets. And these 7 are perceived as the best.
They're also linked to the AI revolution, right? These are the 7 assets that literally invested into AI. So it is much better if something was to succeed, it would be these 7, gold and Bitcoin. And doesn't it ring a bell? Because even in crypto world right now, only the best assets are rising. All the altcoin trash that we have been warning you against for the past 2 years by saying winners keep winning, winners keep winning. We keep telling you that. Why is that? Because flight to perceived safety. Dollar is trash, so where do I put my money? These are the places. Make sense? So I'm going to repeat it, but it's the same dynamic driving gold higher. Same dynamic. When $10 trillion in liquidity needs a home, it flights to quality first. Gold is quality in commodities. The Magnificent 7 are quality in equities. Bitcoin, Ethereum, Solana, quality in crypto. So they are getting bid up, not because they're becoming more valuable, but because the money measuring them is becoming less valuable. Last point. Some of you might have read The Intelligent Investor, the book.
Benjamin Graham.
Some of you maybe have financial qualifications and have learned about the DCF models, right? Like I have with the CFA. Well, when you're trying to, the whole theory of this is based on the fact that you're measuring those assets with a fixed denominator, but the dollar is losing value. So that throws the entire theory down the drain. All of it. So you're not in the same world anymore. And that is why gold at 3,600 makes perfect sense alongside S&P at records. Smart money sees the same ending. Currency debasement forcing everyone into the same crowded trades until the concentration becomes unsustainable. So the trade here isn't to short the market. Never fight liquidity. The trade is to own quality outside the Magnificent Seven, and then gold and Bitcoin. And of course, we'll talk about the crypto portfolio as well in detail. Okay? All right.
Okay, so we just mentioned quality outside of the Magnificent Seven. So let's dive a bit deeper into that. Everyone is obsessed with NVIDIA, up 180% this year, $3 trillion market cap. We can call NVIDIA the AI darling. But money is already rotating to the next layers of AI winners. So think about the California gold rush. Who got rich? Not the miners, right? The people selling the shovels. Same thing happening now with AI. High capex businesses that benefit from rate cuts are setting up perfectly. And these aren't sexy names, but they're printing money. So you have Constellation Energy, CEG, the ticker, up 140% this year. They provide power to data centers. Every new AI cluster needs massive electricity. Rate cuts make their expansion cheaper. Then you have Vistra Corp, VST, up 200% this year. Same story. They have long-term contracts with tech giants to power AI facilities. So lower rates mean faster build-outs. You have Digital Realty Trust, ticker DLR. It's a right that owns data centers. So dividend yield of 4% plus AI growth. So when rates drop, rights usually go higher as yield seekers pile in. And finally, you have Vertiv Holdings, VRT, which is up 300% this year. They make cooling systems for data centers. Why? Because AI chips run hot. And if there is no cooling, it means no AI. And their revenue is growing 40% year over year.
So you see, these companies benefit from a triple whammy: AI infrastructure demand, rate cut benefits for high capex businesses, and they're still under-owned by institutions. And I saw a question again in the chart saying, yeah, but don't you think there is a bubble? Well, do you think, I'm going to ask you a question in response. Do you think that the bubble has bursted or will burst before even the rate cuts happen? Probably not, because the liquidity is going to trickle in. And the whole point of a bubble is it's going to go way higher than you expect, and that's why it's a bubble. So no, I don't think that the bubble has bursted. Do I think that we're going to go into a bubble? Yes. I mean, with so much money entering the markets, definitely. All right, so as you can see, we're starting to add equities. And it makes sense, right? We preach the all-weather portfolio. Tokenized stocks are now taking over. And we are obviously going to help you make the most of this opportunity. You're going to be the first people out there, the first community that knows everything about tokenized stocks. So drop it in the chat if you enjoy us talking about equities. That would be helpful for us to know if we should keep doing that. Awesome. Well, by the way, in that case, oh, that's a lot of people. Awesome, awesome.
Nice.
So if you don't want to wait, by the way, every 2 weeks to hear from us, you can actually also get day-to-day information on our social platforms like Twitter, X, or LinkedIn. We're on both, where we post insights about the markets, about stocks, about crypto daily. So come interact with us in the comments of our posts. We'll show you some love, and we'll reply there. By the way, big props to Alessio, Teresa, or even Caroline that we often see in the comments of our post. We very much appreciate it, and we will reply to you live. So I'm gonna drop right now our social handles, Salim's Twitter and LinkedIn, and my Twitter and LinkedIn. These are safe links that you can click on, and you're gonna be able to follow us. We literally post every single day, both of us.
In case you don't see our faces enough. Now, the real tell about where we are in this AI infrastructure boom came last week with a single announcement that sent shockwaves through the semiconductor industry. And it showed us that even in the hottest sector of the market, the rotation game is already beginning. So last week's Broadcom announcement was sort of a masterclass in reading rotations. They announced a $10 billion custom AI chip order from a mystery customer. Everyone thinks it's OpenAI. Stock exploded 15% in a day, adding $100 billion in market cap. But here's the tell. NVIDIA dropped 3% the same day. The market's message was clear. AI demand is real and growing, but it's diversifying away from single suppliers. This creates opportunity. Look for the NVIDIA alternatives. So what do we have? We have AMD, which trades at 45 times earnings versus NVIDIA at 65 times. So undervalued compared to NVIDIA. Same AI exposure, 30% cheaper valuation. You have also Marvel with 2L technology. $900 billion AI chip market opportunity, but $90 billion market cap. So the asymmetry is obvious.
You also have Intel. You probably heard about it. It's made a lot of noise in the US. Everyone hates it. It's down 60% from highs, but they are investing $100 billion in US chip manufacturing. So when supply chains matter again, Intel might win. Now, here's a disclaimer, guys. We are giving you AI investment ideas here for you to go and research for yourself, because it might be a good moment, you know, with the rush that is happening. We are absolutely not recommending any of these names for purchase. We are currently hiring and looking to strengthen our team with equity experts to expand our offering for you guys. If you're a paid member, it will be included. We're trying to find mentors who are extremely good with the stock market. As you know, we hire only the best of the best mentors. So stay tuned. We'll keep you posted. And if you think of someone that could be interested, just let our team know. So the pattern is clear. Money rotating from expensive winners to cheaper alternatives within the same theme. So from story to value, from hype to revenue, okay? Flight to safety in a certain way. This exact same rotation dynamic is playing out, as I said before, in an even more extreme way in crypto, where the contrast between narrative and fundamentals has never been starker. So while institutional money searches for the next NVIDIA in semiconductors, retail is discovering that the real rotation opportunity might not be in stocks at all. It's in the asset class that moves 10 times faster, with 10 times the volatility, but 10 times the potential returns when liquidity flows hit.
But what asset class are you talking about?
I really wonder.
Do you guys know? It is crypto.
Crypto, of course. All right.
So remember how we just showed you 7 stocks controlling 35% of the S&P 500. In crypto, we have an even more extreme concentration story, but it's unwinding in real time. Bitcoin hit $122,000 in mid-August, Beautiful new all-time high. Then it pulled back to $115,000. Most people focus on the price, right? But they're missing the real story. The same rotation from expensive to cheap, from large to small, that's happening in semiconductors could be about to explode in crypto. So Goliath leads and David follows. I don't know how you Americans say it.
The French way is better.
Yeah,
David.
exactly. Well, Bitcoin dominance, aka Bitcoin's percentage of total crypto market cap, peaked at 59% in early September. Now it's rolling over currently at 58%. That 1% drop might sound insignificant, right? But in a $3 trillion crypto market, that's $30 billion rotating from Bitcoin to altcoins.
Interesting. So you guys probably remember this, how money flows in crypto. And we told you this cycle follows the usual money flow. Nothing changed. It's playing out exactly as it has 3 times before. Bitcoin leads, and it has done that for probably over 2 years. It establishes new highs, it builds confidence. Then money rotates down the risk curve because Bitcoin is considered as the least risky in the crypto asset class, right? So first to Ethereum. What did we see this summer? Ethereum outperforming by far the entire market. And then between phase 2 and phase 3, we have a phase overlap where money is starting to trickle into large caps. And this is pretty much where we are, guys. We are between phase 2 and phase 3. Okay. Next up, large caps will outperform. We're seeing a lot of strength on Solana, like we told you. And then at the end, we're going to have alt season, where lower caps start going vertical with insane parabolas, right? And that happens all very, very fast. So you don't want to miss it. So we wouldn't be surprised, as we told you 2 weeks ago, our stance hasn't changed, that when the Fed announces the cuts, there might be a lot of market volatility in either way. And possibly it could be some down movements initially as a short-term sell the news events before the leg up starts. Okay? It wouldn't surprise us. Now, let's talk about why hype changes everything. Mr. Salim, why don't you tell us?
All right, so forget everything you know about crypto narratives. Meme coins, celebrity tokens, political projects, they're all dying. The winning formula, in our opinion, for this cycle is shockingly simple. Tokens generating real revenue. And even better, using the revenue for buybacks. And Hyperliquid, Hype, is the perfect case study. They're running a perpetual futures exchange doing $3 billion in daily volume. So real trades, real fees, and real revenue. Now, here is their genius part. They funnel 97% of protocol fees into buying back hype tokens. Not 10%, not 50%, 97%. They've already repurchased 30 million hype tokens. That's 9% of the circulating supply permanently removed from the market. On your screen, you can see a chart showing these buybacks as they happened. The black line is the price, but you can barely see it because all the orange dots are hype buybacks made from protocol fees. So think about this like a traditional stock. When Apple buys back shares, the remaining shares become more valuable. Well, same principle. But Hyperliquid is doing it at a scale that will make even Apple jealous. The numbers are staggering. Crypto protocols are spending $40 million per week on buybacks. Hyperliquid leads, but others are following. So, in a nutshell, this is traditional finance mechanics applied to crypto.
It's happening, finally.
Yeah. And Wall Street is paying attention because when institutional investors see revenue-backed tokenomics with buyback programs, they recognize the model. And it's what they've been doing in traditional markets for decades, right? So it's familiar for them.
Now, all this to say that we told you. We told you. And if you've been following the market updates, de rien, like we say in French, you made money. So you might remember we've been talking about hype on market updates for a couple months, more than that now, probably way more than that. It was around $20, I think. So we're almost at a 3x. But if some of you got and bought hype when we told you to, let us know in the chat if you did.
That would be when you told you we did.
When we told you we did. And okay, if you don't remember, we even gave 3 buying points across our market updates. We said we're buying hype at 42, 39, and $36, if you remember well. That was literally a month and a half ago. As you can see on the chart right now, in 42 days, that gave you a 60% return. Not too bad.
Juicy. Now, while protocols like Hyperliquid are using their revenue for buybacks, there is $300 billion in stablecoins sitting on the sidelines, earning yield and waiting to rotate into exactly these kinds of revenue generating protocols. Think about it. We just showed you how global liquidity is expanding by $10 trillion. In crypto, we have our own liquidity metric that's even more precise, right? Stablecoin supply. And what that metric is telling us should have every crypto investor on high alert. Warning, warning, it's coming. So why is that? Because the total stablecoin supply sits at just under $300 billion. In previous cycles, when Bitcoin pulled back 10%, stablecoin supply will drop 20% as people fled crypto entirely. This time, Bitcoin pulled back from $122,000 to $115,000. And stablecoin supply actually increased by $5 billion. The money is not leaving, it's waiting. Think of stablecoins as dry powder. Almost $300 billion sitting on the sideline, earning 5 to 10% yield, waiting for the next opportunity. When Bitcoin dominance drops to 50%, when alt season accelerates, where does that $300 billion go? Into altcoins. The smart play isn't trying to time the exact bottom. It's positioning before that $300 billion starts moving. Because when it moves fast.
That $300 billion, by the way, just by itself, represents around 40% of the current altcoin market. So if that money comes in, it's boom, 40% gain right away. Okay, guys, it's time. It's time for what you paid for. This is where everything comes together. We are now going to talk about actionable insight by portfolio archetype. Okay? We have shown you the rotations, the opportunities, the warnings. You really understand the game right now. Okay? Well, now, John, Mark, and Francis are going to be our case studies today. Now, who the hell are John, Mark, and Francis? They're fictional. Who cares? But today, we will see how John, Mark, and Francis